Welcome to all of you. Uh, Given that Chennai is my hometown, I was deeply disappointed that I could not come because of my cough uh, and fever. But it's a great pleasure to talk to all of you at Tamil Nadu Investor Association. I've spent 34 years in investing starting from 1989, and it's been a very, very interesting 34 years. In this 34 years, I must first appreciate the role of the regulator and all the intermediaries in making this entire market much more efficient. I can imagine the cost of transaction and the kind of settlement and trading systems which were there in 1989 and what it is today, thanks to the effort of the regulator. Similarly, for example, in the mutual fund where I've spent 19 years, it has been a great experience because both the regulation and what ICICI could do resulted in a huge assets under management that I get an opportunity to manage 6 lakh crores of other people's money over a period of time from almost nothing in 2004. I must start by saying that investing is not arithmetic. Everyone thinks that in investing you won't make mistakes, but in investing mistakes keep happening, and the challenge in investing is you have to make few mistakes and get many things right. So even the legendary Warren Buffett, if you look at it, has made a few mistakes. For example, he talks about his mistakes in Dixon Shoes and Tesco and IBM and in precision shaft, etc. So it is impossible in investing not to make mistakes. And the day all of you come to a conclusion that you will never make a mistake, I think it is going to be very difficult. And one of the key lessons that I have learned over the 34 years of being in the markets is that mistakes are part of investing, but you should make fewer mistakes and get many things right. And this is the most important thing, if you ask me, as far as investing is concerned. And every time you make a mistake, you have to go through an introspection exercise and realize what you learned from that mistake so that you don't repeat it again. The second thing which not automatically has to come to all of you is that the easiest job in investing is buying. People don't realize it, but when I started my career in 1989, 89-90 was such an easy period to buy stocks. To buy stocks, all you need to do is you need to look at the annual report, you need to look at the business, you need to look at the valuations, you need to think what will this company do over a period of time, and it becomes very, very easy to buy. And actually all the investment literature is also focused on buying. So actually buying is the easiest part of investing. And I'm sure you would have been subjected to many books and lot of things on buying. And for example, in this cycle which started in 2020, there have been a lot of advantages for investors, and I worry about it, that many of them started their investing career in 2020 at a very, very good time. They bought shares cheap, the timing was fantastic, the stocks were very, very cheap, and you could buy them cheap and you made very, very good money. But that is not the difficult part. The difficult part comes now. In 1989-90, I didn't realize it. But in 1994-95, in the bull market of 94-95, I realized it was very, very difficult. I did not know many things at that point of time. When you are in a big bull market like 94-95, like we are in a bull market in 2023, you have to recognize that you are very, very different situation from 2020. And therefore, you can make many mistakes. And what is the lesson that I learned from 94-95 is that the most important thing is asset allocation. What happens is that in 1994-95, you cannot have an allocation to equity as much as what you had in 1990 when the market was very cheap. In 94, 95, you had to have an allocation to equity which was lower, but that was not to be. Take a time like today. Is there anyone investing in debt? The answer is no. Is there anyone investing in any cautious product at this point of time through the mutual fund industry? The answer is no. Is the derivative exposure and open interest in stock options and stock futures high? Answer is yes. So what people are doing is what is called as reverse asset allocation, which means that when the markets are high, people are not cautious, which was the mistake that many investors made in 1994. And the single biggest lesson that one learned from 94 to 98 was that asset allocation was very important. And what is asset allocation? It is actually very simple. Asset allocation is taking out money from an asset class which has done extremely well and pushing it to an asset class which has done very badly. So go back into history. In 1998, debt used to give 16% interest rates. So if debt used to give 16% interest rates, it was very logical you had to invest in debt at that point of time. In 2002, debt used to give 4% interest rates. So it is very logical that you have to move from debt to equity in 2002. So today, what is it you need to do from an asset allocation perspective? Look at the 10-year return of small cap index. It is 20% CAGR. What is the 10-year return of mid cap index? It is 22% CAGR. So what is the simple thing that you have to do? You have to take out money from small and mid cap and move it to something safer at this point of time. That's what asset allocation tells you to do. What does the mutual fund floor show at this point of time? Exactly the opposite. What we call reverse asset allocation. So that is, why does this happen? Because somehow behavioral finance always forces you into reverse asset allocation. Having been an infrastructure fund manager in 2007, I couldn't manage to collect money in my value fund called Value Discovery, and money kept coming in infrastructure in the same way, what I call reverse asset allocation. So it's very important that people practice asset allocation. Is it rocket science? The answer is certainly no. There is no rocket science involved at this point of time in this entire framework of asset allocation. So, but the logic of how investing has to be done when the cycle is more advanced is very, very different from when the cycle is very, very cheap as it was in 2020 or as it was in 2002. From an equity investor point of view, how I came up with asset allocation was through my guru, Howard Marks, who talked of cycles. Cycles was one of the most important learnings which I have after the global financial crisis. Cycles is art. As Howard Marks says, it's a pendulum. In that pendulum, you can have sometimes extremes, which is extreme positive. Sometimes you have extreme negative, and sometimes you have in the middle. Now, how to determine where you are in the cycle is art, and you can get it wrong. So the factors that you make use of certainly is how much of institutional ownership is there in the sector, how's the valuation of the sector on various parameters compared to the past, what kind of sentiment is there in IPO market in that sector, and what is the general margins profile in that sector. So these are some of the factors that you can use to determine cycles. And cycles is one of the most interesting because you go back and look, there are times when people are extremely positive on sectors. There are times when people are extremely negative on sectors. And at all points of time, it is important for investors to close their eyes 15 minutes a week and think where they are in the cycle and what are they doing with their investments in the cycle. And if they do that, I think there is a huge amount of learning you will get. And what you do in asset allocation should always be a function of where you are in the cycle. So when the cycle is extremely exuberant, you have to be careful. When the cycle is extremely pessimistic, you have to be very, very aggressive. And that is the biggest learning that I got from Howard Marks over the years. The second important learning which over the years, which is not my biggest area of strength, is structural investing. And if you look at a country like India, you could have taken a call on something like private sector banking or retailing or many sectors like that, or IT services, and you could have held it for 20 years and made huge money. And if you had bought it right at the beginning of the cycle and then stayed on for 20 years, the kind of returns that India has given in many of these sectors has been stupendous. Frankly, it doesn't require any rocket science to know that private sector banking was going to grow, or retailing was going to grow, or even telecom was going to grow. But it required patience and the right company to bet on. And it requires some amount of stock picking skills. And I believe it's one of the very, very interesting areas of investing, which I'm sure today the entire day would have been very, very enjoyably be spent by most of you in this area. And I believe structural investing is something which is very, very enjoyable for most people. For example, globally, people who got things like Apple and Google and Amazon and Tesla right, they have had such a fantastic experience as investing, because it was the best kind of structural investing that you could have ever done in investing at any point of time in the world. The other important thing, which over a period of time, over a recent period of time, we spent a lot of time reading Pulak Prasad's books. Then we always spend time reading Howard Marks' memos. I got on a chance about 10 years back to hear Warren Buffett in Delhi. There was one thing which came out very, very clearly from all these things, which is that market sometimes goes to extremes. And when it goes to extremes, you have to act. And this number of times it goes to extremes is very, very rare. It goes maybe once in 5 years, once in 10 years. In fact, in that meeting where with 500 people, Warren Buffett said it normally comes once a decade. And in 50 years, he said there were 5 opportunities. In those 5 opportunities, for example, you have to act in a very, very big way. Do you have the capability to act in that very, very big way when the market is at an extreme? That is the challenge of all investors. If you decide you're going to act in a very, very big way each day, then you're not going to make money. And in my opinion, such opportunities come rarely. So if you go to my 34-year period, 2002 was one, 2008 was one, March 2020 was one. So you do get such opportunities. And when you get those opportunities, how do you use them is the biggest investing opportunity, and you have to use them. And, you can't say that I want to invest today. And this comes to a very controversial point that I want to talk about. My view is, if you want to be a good long-term investor, you can't be full-time. You have to be part-time. In fact, I was studying what is the positive of what Warren Buffett and Charlie Munger did was they don't do only investing for a living. They do investing and then they run businesses. In my reading, having watched, I've spent 10 years in stockbroking, now spent 20 years in mutual fund almost. So in this 30 years, what I've seen is it is not logical for people to be full-time in investing. When you're full-time in investing, the biggest challenge that happens is you don't give the time needed for returns to come from stocks. For example, if I bought a power stock 4 years back and it took 4 years for the returns to come, would I be patient for that 4 years if I was full-time in investing? That is a challenge. If I bought telecom stock 6 years back, would I be willing to be waiting patiently for 6 years and continue to wait, saying that the top has not been reached in telecom? Would I buy a metal stock and say, I'll wait for the cycle to work? Would I wait for a differential voting right discount of 50% to narrow and wait forever for that discount to narrow? So I believe very strongly that investors being part-time gives them a huge opportunity. So if you're able to be an architect, if you're able to be a chartered accountant, if you're able to be a mutual fund distributor, if you're able to do any other work, if you're a doctor, I think it's much better to be a part-time investor. For example, as a CIO, I am involved in so many things. I have to learn about, for example, new age companies. I have to be involved in training many of my younger colleagues on how to approach fund management, how to approach equity research, how to involve myself in many things. So while I am a full-time investment professional, I'm not every minute bothered about what has happened to my portfolio, because finally I'm investing for the long term. And it's something which I've seen over a period of time. And that too, my 10 years in stockbroking taught me that all the people who are part-time investors actually had a much bigger headway over all the people who actually had a situation where they thought of investing as a full-time profession. I believe investing is a fantastic part-time profession. And along with that, even in India, you've seen people who have been phenomenal investors. One of them is running a phenomenal retailing company. Like that, we have seen another person start an airline. So like that, you've seen different people. Another person has set up a beautiful university. I believe it is very important for investors actually not to be over-focused on only investing, because investing is not a business which gives you monthly income. It is not a business where you can be sure you can make money every month. The day you decide, there are a few people like Renaissance Simons who managed it, but other than that, most people can't manage this whole concept of trying to make money every month. They have to make money over a period of time, and that when you get the money is very difficult to judge. And that is the reason why I believe it is very important for investors to do a second activity along with investing, for them to actually have the thrill of investing. And this is something I've realized over the years and found it very difficult to convey to a lot of people, that you can be a teacher, you can be a professor, and you can do many, many other jobs along with investing, and that will be far more rewarding from an investment professional point of view. My next learning was use market cap at extremes. In fact, in my earlier talk in CFA Institute in 2021, the extreme turned out to be that PSUs as an aggregate market cap was so cheap compared to most large caps. And no one could believe at that point of time, 2 years back, that this kind of outperformance would come in PSUs. And this was not the first time that in extremes, market caps have shown huge ability to deliver alpha. Whether it is in 1999 in tech, in 2007 in infra, in 2015 in pharma, in 2021 in FANG. I believe these extremes in market cap can be used to actually deliver huge alpha by comparing market caps. It is not that the market cap which is high needs to go down. It is the market cap which is high needs to be sold or switched into the market cap which is low. For example, it is not that the large cap Indian companies did badly. It is the PSUs outperformed the large cap Indian companies. And this model should not be used again on a daily basis. It should be used in extremes, and when the extreme comes, it is useful to actually act in a very big way. Out of all these things, what came out was that the famous Seth Klarman's quote that the entire concept of value investing is contrarianism with using a calculator. And this has proved to be something which we have tried to use at ICICI in a big way. And this process has actually helped us to manage larger and larger sums of money over a long period of time. Having said that, the whole calculator part is forgotten very frequently. For example, in many of the NBFCs and some of the private banks, the calculator told us not to invest, and it turned out to be a correct decision. On the other hand, in one of the telecom companies, we went wrong on the calculator because we went wrong on a court case. And that resulted in a loss because while we did value investing, we missed the court case properly. In another case, we looked at a tea plantation company and said this company has 15,000 acres of land. But we forgot that that company in their balance sheet had taken out a lot of money and given it to another company in the form of loans and advances. So the key is what Seth Klarman mentioned, which is that at heart, if you want to succeed in value investing, you have to be contrarian, but you have to go right on the calculator part of it also. And if you don't go right on the calculator part of it, you're not going to win in contrarianism. And that is the challenge of value investing, that sometimes people think value investing is just buying something cheap. If you did something cheap, you would have bought junk infrastructure stocks in 2007. You would have bought the wrong NBFCs in 2017-18. That won't work. You have to do contrarianism with a calculator for you to succeed in investing at this point of time. And at all points of time, this is the model which works. Why is contrarianism useful? Because as you succeed, you manage more and more money. So as you manage more and more money, when you're contrarian, it is very easy to manage to buy. And as you are contrarian, it's much easier to manage to sell. So today, for example, if you wanted to sell small cap, it's easy. If you wanted to sell PSU, it is easy. And if you follow only one style, it becomes a problem. So all the people who are just quality got into trouble in 2020 to 23, although they had a beautiful 2017 to 2020. There are people who say, I'll be only small cap. But they had such a bad experience between 2006 and 2013. So contrarianism does not say that you are small cap, your quality, your growth, your value, your mid cap, your large cap. It hunts for where there is intrinsic value upside, and therefore you're everything. And that we have found it to be very useful in the entire process of managing large sums of other people's money. One last point, I mentioned this even in my last Bulletproof Investing seminar. There is a time to measure your performance. Today, if you're a small cap investor, today is not the time to measure performance. If you're a Chinese fund manager, today is not the time to measure your performance. You cannot measure performance when markets are either too high or too low. That's a wrong time to measure performance. You have to measure performance when you're in the middle and not when markets are at extreme. So if you started measuring performance on December 2007 or December 2008 or March 2020, you will get all kinds of wrong signals. Like that today, if you start measuring yourself as a small cap fund manager, because performance is extremely good, because after 10 years of 20% CAGR, it's a wrong way. So you should measure performance when things are somewhere in the middle and over long periods of time. And if you start measuring performance at the wrong time, actually it will hurt you. And you should also not measure your performance in the midst of a big bear market, because sometimes bear market can also be irrational. Imagining measuring a Japanese fund manager in 2022 or measuring them in 1990. So I think it's very critical that you should choose to measure yourself at the right time. To sum up, the whole investing game, which is very, very rewarding financially, is actually common sense. How to practice common sense in the long run is the biggest challenge for all investors. Particularly for people like us, when we are managing other people's money, it is even more tougher because we are answerable to other people. When you're managing your own money, it is very important to remember, finally investing is common sense. Was it common sense to know that in March 2020 market was cheaper? The answer is certainly market was cheaper. It was so easy to know. Was it common sense to know that in December 2007 market was very costly? Answer is it was very simple. In December 2008 market was very cheap. Was it common sense? The answer is yes. Is it common sense to know that small and mid cap is very overvalued compared to large cap? The answer is simple. It is common sense. So, but how to practice common sense in investing is the biggest challenge for investors. All of you as individual investors are in a much, much better position than people like us. Why? Because we are answerable to society, we are answerable to everybody, and we have people coming in at various points of time, and we are not managing our money, we are managing public money. When you are managing your money, you have much more freedom to practice common sense and never worry in the near term, because in the long term, common sense will always win. And that is very, very important for you to succeed as investors. Never fear the near term. If the market goes irrational in the near term, never fear it, particularly if you're managing your money. If you're a mutual fund distributor, obviously you would have challenges. If you're a fund manager or a CIO like me, we will have challenges, but that is the job of communication, and we have to handle irrationality in markets on a continuing basis. Having said that, in the long run, markets will be rational, markets will show common sense, and in the long run, in the 34 years that I have been in investing, markets have been sensible. So the markets give you superb opportunity if you are rational in an irrational market and somehow wade through it and succeed in managing to be rational in an irrational market. Thank you for giving this opportunity, TIA.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.